Hello, everyone. Jim Richardson here. I'm the events chair of the Harvard Club of Minnesota. And thanks all for joining. I'm sure more people will be dialing in the next few minutes. Before turning it over to Lauren Pradhan to launch our event and introduce our guest, let me just mention a couple of things. We have some upcoming events that you might be interested in. This year, because of pandemic, we can't have a face-to-face annual banquet as we usually do in May, but we do have two Harvard faculty speakers speaking to us via Zoom. One is David Harris from the law school speaking on We the People, ideology, ideal, and racial justice. We also have another law school professor named Michael Klarman, who's going to speak about the degradation of American democracy. This has been very controversial where he's presented before, but it should be a lot of fun. And finally, I think we have we have another CEO series event. Andy Cantwell with of Carlson Private Capital is showing up on the 20th of April. So those are our upcoming events. Someday we will be able to meet again, but I must say there's an advantage of Zoom as well in that we can get speakers from Cambridge without their having to actually come to flyoverland. Anyway, now let me turn it over to Lauren Pradhan, who assembled this event. Thank you, Lauren. She's a B School grad and a new addition and very energetic addition to our board, so I appreciate her being here. And off we go. Thanks, Lauren.
Well, thank you, Jim, and thanks again to Jim for helping coordinate. He is truly the glue that keeps the Harvard Club together. I'm Lauren Pradhan, HBS 09, and thrilled to partner with Dino on the CEO series. And our theme this spring has been about investment in capital and investing in the community. And so thrilled to have Brett and Mary from Bread and Butter Ventures talk about the Twin Cities startup scene and investing in early stage companies. Just a quick intro, Brett, Brohl and Mary Grove are the general partners for Bread and Butter Ventures, which is an early stage venture capital fund. Prior to Bread and Butter, Mary had spent 15 years at Google, where she was the founding director of Google for Startups before she joined Revolution's Rise of the Rest seed fund as a partner. And Brett is a lifelong entrepreneur. He's launched and run Techstars Farm to Fork Accelerator and has made more than 40 seed investments since 2017. The format for our time together, this is our first lunch and learn, so thank you all for joining us, will be Mary and Brett will kind of go through the startup community here as well as how they think about investing in companies for about half an hour, 40 minutes or so. And then we'll have time for questions, so please put questions in the chat. And then I will read them out and Brett and Mary will tag team and answer. Jim's gonna keep everybody on mute just so that we keep things quiet for our speakers. And that should be it. So with that, I will turn it over to Mary and Brett. Thank you so much for joining us today.
Thanks for having us. It's fun to do this and fun to be here. And it'll hopefully we'll be able to have a good conversation. And Mary and I really do like the questions in the back and forth. So please do put stuff in chat. And we're happy to kind of even break into the presentation. Neither of us are super formal. So if there's a very timely question about something we just went over, Lauren, feel free to interrupt us if in a pause. And so we can talk to it at that moment in time, if that's quite all right. Yeah, but we're excited to be here. We're going to do a quick little agenda. We'll tell you a little bit more about the Twin Cities startup community. We're going to tell you about ourselves and then walk through two different types of early stage investing is our quick agenda on our side.
Perfect. Thanks, Brett. And thank you, Lauren, Jim, and Dino for having us. Thrilled to be here with you. So to start off, we'd love to introduce ourselves a bit more. So as Lauren shared, Brett and I are the general partners here at Bread and Butter Ventures. Our teammate Stephanie Rich is also on the line with us today as well. And just some personal backgrounds. I'm relatively new to Minnesota. I've been here for 3 years to the month. It's been an exciting journey, but my background is really in tech and early stage investing. And so just a few stories to illustrate my journey and how I got here. I come from a big immigrant family of entrepreneurs. Parents are immigrants from Thailand who embody the quintessential American dream. And built and ran small businesses together for over 30 years. That's the photo on the bottom right is some of my relatives back home. And ended up in Silicon Valley for college. So I went to Stanford for undergrad and grad school, which sort of serendipitously got me into the door at Google, where I spent the first 15 years of my career, as you heard earlier. But the spark that really ignited largely what I'm doing today is the photo on the top left, which is the Google for Startups team. And so had the opportunity to help build Google for Startups for the company, which is the company's umbrella for investing in startups, but also ecosystems around the world in over 130 countries. And so deeply believe that innovation is not just happening in Silicon Valley, and it's places like Minnesota that are the future of the innovation economy. And so I started a nonprofit called Silicon North Stars with my husband, Steve, who is a Minnesota native, back in 2013 to help educate and inspire young kids from economically underserved backgrounds here in Minnesota towards futures in tech. And that work continues today. I still run the organization. And that is actually how Brett and I first met. So Brett was a volunteer mentor coach for our kids for the last 6 years. And that's been a really fulfilling piece of my life. And then the bottom photo there is what part of what drives me every day, raising my family in Minnesota as part of this community. And I have 4-year-old twins, and we're having a lot of fun.
Real quick on our side, the one thing that Lauren didn't mention, I was actually also an entrepreneur for quite some time. And so I've raised venture capital. I've also bootstrapped companies and taken a couple to exit, and also had a few that haven't been as successful. Moved to Minnesota in 2009. My wife actually got a job with General Mills, and I was a trailing spouse. I was a lowly entrepreneur, just me at the time, working on trying to build something kind of cool. So progressed through there. We sold our last company at the end of 2015. And some of my investors were involved with Techstars and asked if I'd help spin up our Techstars retail accelerator program that was in partnership with Target at the time. And it was a traditional venture EIR role where I'd come in, help spin something up while I was working on my next concept, and then everybody would invest in that thing, and we'd all go our own ways and continue to work together as we had more traditionally. I ended up really enjoying the investing side of it. I did some angel investing in 2016. And then raised the first version of Bread and Butter Ventures in 2017 and deployed that over 2017, 2018. 2019, we raised Fund 2, which was the second iteration. We deployed that in 2019 and 2020. Mary and I would deploy that capital together. And then more recently, we've been raising Fund 3, which is the third iteration of Bread and Butter Ventures, and made a significant amount of investments over that time period, both angel, direct into startups, and also had the opportunity to build the Techstars Farm to Fork Accelerator, which is a program that's in partnership with Cargill and Ecolab here in town. So I love entrepreneurship. My entire career has basically been entrepreneurship. And it's been crazy that we've been in Minnesota for 12 years. And Mary and I are both, since I've been here, it's been really incredible to see. Part of what we're going to talk about is, and I think Mary's going to do next, is like the ecosystem here in the Twin Cities. And just one quick point before I hand it back to Mary is when I moved here in 2009, I remember I was a startup entrepreneur looking around the community, like, where the hell are the other entrepreneurs? Like, where is the ecosystem? What's going on here? And it's been incredibly gratifying to see how much it's grown over that time, and especially in the last 6-7 years, and the true amazing number of opportunities for founders, for entrepreneurs, for support organizations, and for a variety of other things that are going on here now. So it's been really fun to watch and be a small part of over the last several years.
Brett's also an avid meat smoker, as you can see from the previous slide. So excited to tell you a little bit, just to zoom out and talk about the Minnesota tech entrepreneurial venture ecosystem at large. And as Brett just shared, we feel like it's come leaps and bounds forward in the last decade, certainly in the last 5 years, and certainly in the last 3 years that I've been able to experience being here on the ground. But when I think about what makes entrepreneurial ecosystems successful, I always talk about 5 key ingredients, and those are talent, density, culture, capital, and regulatory environment. These are the various levers that can really shape an ecosystem and help accelerate it forward. And so as you look at the Minnesota ecosystem through that lens, we have a number of venture capital firms that are either based here or are putting a person on the ground here to really be a part of the ecosystem. This is a snapshot of most. We have some resources later in the presentation. There's an investor education series that we're putting on throughout the year with free educational content. But in January, we did our first session of 2021, and we had 18 active venture firms in Minnesota participating. So that's how it's really grown. One really special thing about our ecosystem is what we call the ESOs, or the entrepreneurial support organizations. Some of the groups you see represented there, like Beta, Lunar Startups, Techstars, of course, Forge North, which is part of Greater MSP. These are really unique that I haven't seen them with such density in many ecosystems around the world. And it's everything from, free resources to training, to community, to networking, to amplification, to pure accelerator models. And so it's an exciting part of what's happening here. Of course, the university environment, both to generate talent, and talent of all types are needed for successful startups, right? Not just technical developer talent of all backgrounds, really. But additionally, we have some really cool programs like the Minnesota Cup, the largest startup competition at the state level, I believe, in the country. One of them, is based right here in our hometown. And then lastly, from a regulatory perspective, what is the government doing to help make it easier for companies to start, to sunset, for them to access capital? So a couple of the initiatives that we're really excited about, Launch Minnesota, which is part of the Department of Employment and Economic Development, has awarded dozens of grants this year, non-dilutive grants to startups, which is very catalytic. I see some of the entrepreneurs on the call with us today. And then things like the Angel Tax Credit, right, which offer 25% break on capital invested into early stage startups. Super, super valuable. It's active for 2021. So if anyone's thinking about angel investing, now might be a good time to take advantage of that.
A couple of other quick thoughts. There is, we are still developing and evolving as an ecosystem as well. And one cool thing that stands out to me about that slide is that venture, like the venture portion of that slide, actually almost every portion of that slide, none of this was here when I moved here in 2009. None of those venture funds were here. Actually, if you even go back 5 years ago, very few of those things were here 5 years ago. And so it's really come a long way in the more recent past versus other things. And we do still have some holes in town, but it's just cool to see how far it's come in the last few years. We're gonna, again, just to kind of like frame how we're gonna walk through. We're gonna talk a little bit about venture just as an asset class, and the way we talk about venture capital and the way Mary and I think about it is early stage, right? So there's multiple stages of private equity. It's funny when we talk to large investors that are investing in funds directly, they kind of lump venture into private equity, which it is, but we're investing in super early stage companies. And what we're going to focus on today are really thinking about doing direct investment, so angel investing, or investing in thinking about how do you invest into a venture capital fund, which is another model of getting into that asset class as an individual investor, and some of the things that you should be thinking about as a direct investor into early stage startups, or as a investor into a fund that would then deploy your capital for you. Generally speaking, we are firm believers in venture as an asset class and as an asset allocation. If you have the opportunity to diversify into this space, and actually with some of the new laws that went live this week, or on the 15th, it's actually even becoming easier and easier for anybody to have access to early stage investing as an asset class. There's reasons why, like the Harvard endowment. I actually think Harvard's endowment has one of the larger venture portfolios in the world. Why they put so much of their capital into the venture asset class, because it outperforms, and it has outperformed historically from an ROI perspective. And we'll talk a bit more about it, but from our fund perspective, if we're not providing at least a 30% ROI on the capital that's invested into our fund, we don't know that we're necessarily doing our jobs well. And so just to give you an idea of that asset class, it is and should be a really great diversification strategy to invest. It's just more a matter of like, how do you get into it, and how do you do it is the hard part, because there's a lot of differences between startups. 90% of all startups fail, right? And so how do you deploy your capital successfully is kind of what we're going to focus on a bit more today.
Great, absolutely. And we think about venture capital as a long-term illiquid investment. By long-term, we mean, we expect to hold an investment for roughly plus or minus 7 years, but both as a limited partner thinking about investing into a fund, or as a venture fund manager like we are investing in a startup, we don't expect to see an exit or a distribution of that capital for about 7 years. And so that's part of the strategies, right? To do the math on what's liquid, what's not. And so this is a long-term investment we think is generally higher risk, but higher potential reward as an asset class. And so what we like to do, we're going to split the next two sections up briefly and give you a quick tour of how to think about potentially investing in a fund first, and then we'll think about what to think about when evaluating investment directly into a startup. And so Brett and I have been part of raising 3 venture funds. And so we're going to walk you through a quick example. This is actually our most recent deck. I won't present the whole thing just for length purposes, but I'll flip through it quickly and give you a sense for if you are sitting in the seat of a potential LP investor into a fund, what are the types of data points and things you should be looking for? So we are Bread and Butter Ventures. We are an early stage firm based here in Minneapolis. We invest nationally. We actually can invest outside the US as well, though mainly focused on the US. And our whole thesis is predicated on leveraging the Minnesota home field advantage, as we call it. So what are the sectors that are super strong, multi-trillion-dollar industries that are headquartered in Minnesota, leveraging the corporate expertise and talent around us to help support our companies after we invest. So we specifically prioritize the big 3 sectors, which are food and ag tech, health tech, and enterprise software. So with this fund, our target is to raise a minimum of 25 million. With that, the strategy is to invest at the early stage, so seed and pre-seed companies. What does that mean? That means that companies are live in market with an MVP or a minimal viable product live in market. And typically they're raising anywhere between $1 and $3 million on average is the round that we participate in. So from this fund, we are going to be investing in about 25 companies in total. And the strategy is, $500,000 first check investment, reserve 40% of the capital from the fund for follow-on rounds, and based on performance into the highest performing companies. And so that's our strategy with this fund. We expect to lead about 35 to 40% of the rounds from this and really take a hands-on approach with our portfolio.
And if you're evaluating funds, right, something to think about, like to Mary's point earlier on around timeline and horizon, the stage that a fund is investing in, pre-seed, seed, Series A, Series B, growth equity, right? That's going to really affect your timeline for returns and when cash is returned to an LP. And so that's why when you look at a slide like this, or when you think about something like this, like that seed stage, how much are they investing, the investment period of how quickly does that fund deploy, that'll also affect when you need to put your capital into the fund. So when, sometimes I think that people, especially people that have never invested in funds, they think about, I'm going to commit $500,000 to this fund. A lot of people think they have to write that check up front. We actually call the capital down over the entirety of the fund. So you're not writing one large check at the very beginning of time. So like just a couple things to call out is like if I'm you and if I'm like somebody thinking about investing through a fund, those are some things that like these different stats matter.
Yep, absolutely. And then we would usually, do a deep dive on the team, and I won't go through that now, but just try to really succinctly get through why we differentiate on team. And then we talk about track record. So what's the historical performance? For seed funds or early stage funds of our size, we believe that it's still quite early, right? Our oldest fund is a 2017 vintage. The vintage year refers to the year that you first began deploying capital out of the fund. And so 2017 vintage, relatively new. What can we show you? We can show you 2 key metrics. The first is revenue growth, which is depicted here. And so this will, we'll convey that, hey, in fund 1, at the time of investment, our companies were doing collectively $7 million in revenue across the portfolio. In 2020, we estimate, and this is actually a true number now, our companies did north of $85 million in revenue. So to be able to show, 12x revenue growth in roughly a 3 to 4 year period, we think we're on the right track. We can also point to things like what's the loss ratio or what percentage of companies you've invested in have gone to zero. In the case of Bread and Butter, we're currently at 0 dead companies. So we point that out because we're proud of it, but you would want to ask, if you're looking at funds who've been around for a while, how many companies have died? What percentage is that? Keep in mind at seed stage, that percentage in market is very, very high, right? So don't be surprised that there will be companies that die. That's totally normal. The second metric is something called TVPI, or it's the ratio of the total value to paid in capital, meaning what's the total value of my portfolio at the moment on paper, and how much capital did I deploy? And so the industry uses data from Cambridge Associates as the benchmark, right? And they release data on each vintage each year. And so we've been able to pull this data. Top quartile means the top quartile number for 2017 vintages is 1.31x. That's the ratio of total value of portfolio to paid in capital. And then we're showing, we're above that is what we're trying to show here. So those are the two metrics to look out for. You also might see MOIC, or multiple on invested capital, is another one. The only difference between MOIC and TVPI, this TVPI number is calculated net of fees and carry, meaning it's like net revenue versus gross revenue, essentially.
You also see IRR is something that gets commonly asked for here too as well.
Yep. And I won't walk through this in real time, but we're trying to show track record. So we're trying to show, okay, these are some of the breakout companies in the portfolio, and who do we want to highlight and why? Typically, you can see the trajectory of revenue growth here, and we'll try to point out, key wins. This is a slide that we included to show these are the investments we made in the second half of 2020 that we made together. So we're just trying to show what are some recent themes by sector, and then we can deep dive into any of them. Explanation of our thesis areas and why it matters. So, what I love here is I think we're sitting on Minnesota's best kept secret. So these are multi-trillion-dollar global industries with unbelievable epicenters headquartered in Minnesota. So from a food and ag tech perspective, Cargill, Ecolab, General Mills, Schwann's, I could go on, right? Within healthcare, United Health Group, Mayo Clinic, Medtronic, Blue Cross Blue Shield, Allina. Within enterprise, we have 57 companies headquartered in Minnesota who are doing north of $1 billion in revenue across such a diversity of sectors. And so our value proposition is we have relationships with these companies, everything from LP capital into our fund to help with diligence, to mentorship for companies, to sales introductions, to long-term, we hope, a path to M&A. And that's, why Minnesota, why are we based here? Really try to get that across.
Hey, Mary and Brett, we have a question specifically on the sector focus, and just you touched a bit on how you chose these sectors. Do you guys think about opportunity cost of that decision, like choosing these sectors versus others, and does that impact like when you look at deals and something falls out of thesis?
Great question. So our strategy is that 75% of our investing will fall into these big three. We chose these for two reasons. One is because they squarely mapped Brett and my investing background. So Brett is a super deep global expert in food and ag tech. He leads that practice for us. I spent most of my time at Revolution helping build a digital health tech practice there. And so I lead health tech investing for us. And then SaaS, we both tag team on. So that's about 75% is where we think it'll land. The last 25% is for generalist. And that's if there's a special opportunity that we're uniquely equipped to support, that tends to be things that are in our backyard, frankly, or geographically close. One good example is Omnia Fishing, based in Minnesota. They're an e-commerce platform and a data company for anglers for the recreational fishing industry. Is there a better place to run that company than the land of 10,000 lakes? We think it's a no-brainer. So we have built in some flexibility there.
One follow-up. Go ahead, Brett.
I think that, before I partnered with Mary, we actually didn't do any health tech investing. And Minnesota actually has a pretty strong health tech scene and med device scene. But it was, one thing we always ask ourselves when we make an investment is like, why are we uniquely positioned to be the ones to put money into this company or evaluate this company or help this company and support this company post-investment? And so, frankly, there's enough, our sectors are broad enough where we could deploy multiples of the capital that we have under management into just the sectors that we're in already. And it's actually like being able to say we don't do any consumer product investing on the food side. Being able to say that actually saves us a tremendous amount of time. I actually think it's more of an opportunity cost by looking at some of the stuff that we just know we can't be as effective in or don't want to do because it takes us away from some of our cores and core areas. So that's it also helps keeps us disciplined a bit as long as we are able to build enough of a diversified portfolio.
Quick follow on. Could you give us some examples of the SaaS companies in your portfolio, or just how you think about SaaS in general?
Sure. So SaaS, it's a broad category of, general B2B businesses or businesses that power solutions for the workforce. Two recent examples we can give. One is a Minnesota-based company called Fulcrum. They've been in the press a lot recently. Sunny Han, their CEO, is awesome. They're building cloud-based ERP software for manufacturing to help, digitize the modern era of manufacturing. And so that's an example of broken workflows in an antiquated, tremendously large industries. One. Another is a company called TechMeet, which is based in Kansas City in New York, and they are building a national platform for IT support for remote and virtual workers. So existed pre-COVID. COVID could not have accelerated a business like that more. We don't think things are going back to completely back to the way they were. So think of the use case of an Amazon or a Google has remote employees in 25 cities. Rather than do one-off contracts with the local corner shop, it's a standardized, guaranteed level of service across the nation. So thank you for the questions. We love questions. This slide is just to show where are we investing? Are you a Minnesota only fund? The answer is definitely no. Our goal is to be the front door to every Minnesota company who's raising, but we definitely invest nationally. So about a quarter of the portfolio are here, 41% are in the Midwest. And then I did want to double click on, we strongly believe that the way to achieve the strongest financial return is to invest in diverse teams, and that achieves better outcomes. And for us, that's a value we hold when we think about LPs who are investing in our fund, when we think about our own team, of course, and then when we think about the teams that we invest in. And so those are the current data metrics from our portfolio. We've got, these are actually outdated. So 46% of our companies have female founders, 63% have a founder who's a person of color. And so, the deal flow is very strong, very diverse, and we're excited to see the progress in that direction.
One other quick thing here, we get the quota question, right? Do you have quotas? Or are you doing things? And we don't. We will. We firmly believe in investing in the best founders, like anywhere they are in the world. And one thing is that, again, if you're evaluating funds, or even some of the funds that we showed early on, there are like geo-specific funds. Like we only invest in Minnesota. We only invest in XYZ. And so if you're ever talking with those funds, like why is this strategy going to outperform other strategies? It's such an important question to ask in those realms or in those scenarios.
Absolutely. I'll just gloss over this one quickly because the biggest things that we look for when we evaluate startups are the same things that LPs look for when they evaluate funds, right? So what differentiates you? I see hundreds, I see thousands of these. And so we try to articulate that. And this slide is one of the ways. So we feel like, our team is unique in that Brett and I have 100% overlap in values and culture, 0% overlap in our backgrounds, and also in the networks that we bring. And so this slide to me drives how we drive that top of funnel, the deals that we see every year, but also how we support them after we invest. And so this, we broke out literally the names of the 450 firms, venture firms with whom we have relationships, have written checks alongside 180 of them at the corporate or accelerator or co-working space, who's got the beat in that city of what's happening. That's where a lot of our inbound comes from. And so this is meant to say, always try to ask them how they differentiate. Everybody will say, like, we're awesome, our team's awesome, but what's the data-driven way to back that up? And so for us, it's that 1,500 deals a year that we're screening. And to Brett's earlier point, the fact that we are pretty specialized really helps, because I can screen 200 health tech companies fairly quickly because I have a few big, thematic thesis areas that we're working against for this year. And so, and vice versa, Brett sees 600 to 700 food tech deals a year. And so it really gets back to that deal flow. We've talked about a lot of this, but we are, in terms of that 1,500 deals, how do you source that? The majority of that, probably 3/4 of that, is coming from the previous slide that I showed, from that broader bread and butter network. But the rest come from, founder referrals is really big. We just closed an investment that was referred to us by a founder, actually a founder we passed on, referred this company that he was an angel investor in. And then we spend a lot of time in the community as much as possible, at least once a week, whether it's, office hour, well, we definitely do weekly office hours anyways, but whether it's judging a pitch competition, getting to speak with a group like this, guest lecturing somewhere. So that drives a lot of our deal flow. And then lastly, before we switch gears, I would encourage you to ask them, how do you engage with your portfolio after you invest? Like how hands-on, hands-off, what does that support look like? And this is where a lot of the differentiation can happen. And so we're deeply proud of the platform that Steph is building for us. Platform is is really what we think of as the ways we support companies post-investment at scale, in addition to Brett and me spending time with them, Steph spending her dedicated one-on-one time with them. So it's things like an experts network, an education series, our LP network, a corporate innovation circle we're launching, scaled resources, and also to connect the founders with each other. And this is very rare. This notion of platform is very rare at the seed stage. It's very common at Series A, B, and above firms because it takes a lot of resources. So I would look into that and then, talk to a founder or two the company's invested in and actually hear from them the ways in which they're adding value beyond the dollar.
Mary, before we get into direct investments, we do have a question on, do you normally take a board seat in your investments? And then speaking a little bit, do you always lead the seed round or do you sometimes participate alongside other lead investors?
Great question. So we are happy to lead. We're also happy to follow in another firm's lead as well. So out of the current fund we're investing in, we expect to lead about 35 to 40%. So if a great fund has come in and set terms, we're happy to be a part of it. If they need a lead, we're happy to jump on it. And we're not shy about investing early. And we're often the first institutional check in the round. So in the cases where we do take board seats, where we do lead rounds, we would take a board seat that comes with that series seed, director seat. And so that is not a requirement in all cases, but I would expect it to happen, 35 to 40% of the time. So we'd love to take more questions on this. Why don't we'll jam through the rest of it. We can take questions maybe holistically. So Brett's going to walk us through how to think about direct investments.
Yeah. So in one quick thing too, right before we dive in, I think it stems nicely from what Mary was talking about, deal flow. One thing when I talk with angels that are thinking about doing, people are starting to think about getting into the angel investing game or the direct investing game versus investing in a fund or not doing anything at all. One question you always have to ask yourself is deal flow. How are you going to get deals? How are you going to find these companies? Why is a startup going to come to you as an investor rather than go to a venture fund and so do you have access to great deals? And what do you want to get out of it? Are you doing it purely for financial return? Are you doing it for to help a friend? Are you doing it to help and support the community? So there's a variety. What I found over time is that angels invest in early stage startups for a variety of reasons. But what I do think is really important is to be really intellectually honest with yourself about why you're getting into it. Don't say you're doing it to support the entrepreneurial community, but really you're doing it for financial returns, because it really should affect how you deploy your capital into the early stage space. And so just be really clear about that and definitely ask yourself the question, why am I uniquely positioned to see deals that deserve to be funded? And if financial return is your most important reason for doing it, then you got to really think about deal flow. Deal flow is the most important thing for what we do. Even if you're the best picker in the world at picking a startup to invest in, if you're picking from deals that aren't that great, you're not going to perform well. And so just really keep that in mind. The other thing that I'll say to keep in mind is, do you have the financial capacity to make 20 angel investments over a year or 2 year period? And it's really important to build, if you want to have financial returns on your direct investing portfolio, you need to be able to invest in about 20 companies over 2 years, in my opinion, right? Otherwise, because you could find the best team in the world with the best idea in the hugest market, and timing just might not be right and it fails. Half the investments that Mary and I make are going to fail and probably not going to provide great returns. And so building that portfolio over time, again, especially if you're doing it for financial returns, there's a lot of stories about the person that made the one investment and it worked out, right? That's the exception, not the norm. You really do need to be able to build a portfolio over time to invest into startups. The way I'm going to kind of walk through this quickly now is we actually have a pitch deck that we actually have a sample pitch deck that we actually put out there that any founders can pull down and then use as a template to get started to build their first pitch deck. And the reason we're going to use this is what we look for, because these are things that we developed around how do we think about what are the important things that we want to know when we first talk to a company. And we can skip over this one. One thing is every startup has different things that are their best thing, and that's important to start off with. There is no one order for a deck. Problem, pain point, and what I think about from the investing perspective when I'm evaluating a company around the problem they're solving, is it an acute pain point versus a nice to have? And so I think that's a really important thing to think about. Is this a must have or a nice to have? You can build big businesses in both, but the companies that are solving a really acute pain point it's far easier to sell into. And oftentimes the nice to haves are the flashier ideas that seem really cool and fun, but at the end of the day, they're actually tougher to build and sell towards. So just really think about that one key thing when you look at a problem of a company. Team, team is the most important thing that we look at. I saw a question come through on how do we evaluate. We actually say team, product market traction, and that helps demonstrate how much we heavily weight teams at the stage that we invest. There's a large number of our companies are going to pivot and fundamentally change what they're doing while they're in our portfolio. And it takes really strong teams to be able to do that. Even like through the pandemic in the last 12 months, you've seen some companies falter and some companies really excel. And it's largely directly related to how good the team is. So team's super important. And we can go deeper on what we look for in teams if anybody's interested as well. But team is the most important thing that we're thinking about. Solution demo. I am actually notoriously bad at looking at products. Like I'll get basically in my mind ready to invest in a company. I've never gotten a product demo. So I am not a product person and never have been. But it is something that if you can use and touch it, like you should use and touch it. Or the other thing that's a great way to do this is if you have somebody in your network that can test the product for you or touch the product for you, whoever that end customer is supposed to be, have them touch it, have them feel it, have them use it, and get the feedback. How good is it? Is it actually truly differentiated? And again, as you think about product, it can't be step change to be a venture backable company. It can't go from like 1 to 2. It's got to be a leap change. So it's got to go from 1 to 10. It's got to be a huge innovation to truly be to have big venture style returns.
And this slide to me, I'll just underscore, is super important from the perspective of, I've bought into the problem and the big opportunity. I've bought into the credibility of your team. And then I can't tell you how many companies, if I can't understand what you do, what's the solution in a succinct, like 2 sentences, essentially. Sometimes I find myself reading through the deck like 4 times. I have no idea what the company does. So being able to articulate very succinctly, this is the solution. And even better to see it live, but just really crisp articulation of what is it?
Traction milestones. One thing I'd say on the traction milestone piece is most people get hung up on that revenue number. Like how much revenue do you have? I actually think at the early stage investing, at the stage that we invest, I actually don't think revenue is the most important number. I would look at usage data, especially if it's an app or any type of software. How frequently are people using it? Oftentimes early stage companies don't know what their revenue formula is even. They don't know how much to charge pricing wise. But you can dig into a cohort analysis and understand the usage data of the software. Usage is an amazing early indicator of product churn and product adoption, right? And so where revenue is a lagging indicator, in my opinion, for these startups. And so really dig into the usage and the usage of the software, not the revenue number. Projections, the rule of thumb when you're looking at financial projections is every single one of them is wrong. What I use projections for is more to understand how the founder's thinking. Is the founder thinking really big, or is the founder thinking, hey, we're going to grow 2x year over year for 10 years? And so really what I'm looking for in financial projections is more how the founder's thinking about the future of their business. And then when you dig into the more sophisticated projections, what are their growth channels? So how are they thinking about deploying the capital that they're putting onto their balance sheet when they take it from us? How are they going to deploy that from a sales and marketing perspective? And so where and how can they deploy that capital to grow top line revenue? So it just really helps me understand how they're thinking. The numbers themselves actually don't really matter to me. It's like, are they thinking big? And then how do they have any idea of how they're actually going to deploy our capital to try and grow the business? Those are the 2 things I'm looking for when I look at projections.
And I would say the corollary to that, absolutely want to know that this is a big moonshot opportunity, you're thinking big, but I also kind of scratch my head when, if a company is pre-revenue right now and the projections, we're going to be hitting 5 million by the end of the year. Keep in mind that if we actually do invest, we will remember what your projected revenue is. So yes, we need to be aggressive, but there needs to be a viable path to hitting some percentage of that as well.
And this is like I mentioned, revenue model, right? Some companies come in, we do want to make sure, do you have an idea of how you might make money, right? Oh, we're going to have all this valuable data and we're going to sell it one day. That's not really a business model or something that we necessarily think is sustainable. Unless you have a really good reason why or how that data becomes profitable for you. So what is that business model? So it is really important for me, it's like, does the founder they might not be right, but do they at least have a theory or a thesis around how they're going to build and scale a company? Market opportunity, again, we're thinking big. Like the types of investments that we want to make are investments that literally one investment can return the entire fund. Mary and I, when we're going through our own investment decision-making process, we ask each other the question like, okay, Mary, how is this investment going to return the entire fund? And in order to do that, they need to be playing in really large markets. And so that's really what we're trying to understand. Like, is this thing big enough? A big watch out here is like when a startup like says the food industry is $3 trillion. Well, yeah, it is, but or whatever. But like the software element of the food industry that you're for your specific use case is not $3 trillion. It's 50 million or whatever. So digging into what the actual, not the holistic market size is, but what's the market size for your current thing, and then what's the market size for the future vision of your company.
I think what you said earlier, Brett's really applicable here about the portfolio approach, right? Where when you said, half the investments that we make out of this fund will die. Yes. And roughly 3 or so investments will return the entire fund. We hope multiple times over. That's the beauty of the portfolio approach. And because you might have been thinking like, why would anyone ever invest in your fund if half the companies are going to die? But it's because this analysis of each one of these 25 shots on goal is $1 billion company. And if the answer is not yes, then it's not a venture backable company. It could be an awesome company, but there's probably a better financing for them.
And it could be a great company for an angel investment, right? Like, again, if you understand like what your strategy is around angel investing, if you go in and find a company that, has some revenue, like has some real traction, the downside, like the chances of that company failing maybe are like really low. The upside might be a 2x in 3 years. Like 2xing your money in 3 years as an angel could be a really great opportunity. For a fund, it's not a good investment, in my opinion. Differentiation, again, like why, like I talked a little bit of this, why is this a leap change, not a step change, I think is really important. And then thinking about like, we do think about like moats, like how are you different from, if I like to say, like, if it's an idea I've never heard of before, it's probably a stupid idea. Because we get pitched by so many companies, especially in our verticals. Like, why are you different from the other companies that I've seen in this space? In some cases, there might only be one other player in it, but like, how are you gonna build your moat and defend it? We talked about marketing and sales a little bit through financials, so we can jump over this one. We can jump over this too. One thing I would say is like, we can talk a little bit about like how we think about valuations and stuff if you want it later on. Vision, I do think this is important. So again, this is all leaning back to that multi-billion-dollar company like goal. Like I ask every founder that pitches us, how are you going to take over the world? That's exactly what I ask every single founder. How are you going to take over the world? Do they have a big enough vision? Are they the type of founder that when they get a $30 million offer to buy the company, which could be life-changing money for that founder, are they going to say, no, I'm not taking it? Like, I don't want that $30 million that's going to put 10 million in my bank account because I'm going for a $1 billion company. Like those are the types of investments that we want to make, is the founders that are going to like literally turn a shoulder at a incredible offer to go big and go for that moonshot. And oftentimes that comes out when they're talking about the vision of their company. That's it.
We do have just closing thoughts. Wanted to bring it home with ways that you can get involved if you're interested in the sector. So, and we can circulate these, but just some of the newsletters that we get daily news from locally about Minnesota. If you want to look up on the Forge North website, the Minnesota Investors Education Series I mentioned, there's 4 videos that are archived there already, including the January one is a really great overview of Minnesota investment ecosystem. There's the 18 funds I talked about. You can consider getting involved. There's a lot of great angel groups. Groove Capital is a new initiative that Reed Robinson is leading. Go for Angels has been around a long time. There are many local funds like ours if you're interested in, working with any of them. And then us specifically, we'd love to hear from you if you'd like. Brett, Stephanie, and I all do weekly office hours available on our site. Anyone in the world can book some time with us, some really fun conversations. It's actually a company we're taking a very close look at right now that came through office hours. We're on Twitter, and then you can also email us directly. We'd be happy to hear from you.
Okay, so with that, we have a couple more minutes left for questions. So if there are questions or areas that the group would like Mary and Brett to dive into a little bit deeper, please put them in the chat. I'll give it a minute.
One question I saw that I don't know that we answered exactly from Dino about like the factors. We talked about team product market traction. There's actually an interesting study done by, I think it was IDEO, that looked at a portfolio of 180 early stage startup investments over a period of time, and they actually their results were that timing was actually the most important factor of the that indicated a success of the startup. And then team was second, but I think a lot of people will say team is the most important thing. But in 2009, Airbnb, Uber came out of 2009, right? Like, would they have been successful if they were formed in 2007 or 2006? Probably not. Like, are you going to let some random person crash on your couch when things are going really well in the economy? And so, and there's so many examples of that where like a startup was actually started like 5 years earlier, completely failed, and then another company came and did the same thing a few years later and was wildly successful.
I also think we're heading into another golden era, I think, and I also hope, right? We know that companies, fund vintages and startups coming out of the year after an economic recession have done very, very well historically. And so 2021, we anticipate that trend continuing.
So we have a question on, do you have experience with impact or social good investing, and do you feel it's a viable sector?
I have a lot of thoughts on this one. We think about the work that we do. We don't think about impact as a separate vertical, but we think that the industries we're investing in are inherently impact driven. So if you think about food tech, health tech as two great examples. Most of the food tech investments we do are also sustainability investments. Many of the health tech investments are directly in the social determinants of health or accessibility plays. We have an investment in a company called Bridge Money that is targeting, it's a neobank, it's a mobile banking platform for underbanked people. So while we don't categorize it as impact, we certainly believe that these are such broad opportunities to do good and do well at the same time. And so it's already embedded in the work we do. We definitely do know many funds we work with who we syndicate those deals to, right? Who are purely 100% quote unquote impact focused. And so I think there's a mix of interpretations of that word. It's a very, very broad word, but we think of it as directly tied to ROI within our sectors.
And I do think a trend that you're seeing in the impact investing space is that funds are coming in and they're basically saying, and founders are coming in and saying, we want to build a big company first so we can have a dramatic impact, right? Versus they're coming in with that, we want to have a dramatic impact, and then we need to figure out how to build a big company. And so a lot of the funds that are coming in around social impact, environmental impact, whatever, they're coming in and saying, we're going to invest in this space, but the number one thing is, does this have the ability to be a humongous company and thus drive the most impact through that? So it's business first, then impact with a mission behind it.
All right, one question that we have is, I'm going to tweak it a little bit, but healthcare, ag, and the sectors that you've chosen are all kind of large industries and obviously not going away. But the organizations, kind of Fortune 500 companies within them, may not necessarily always be the most innovative. And so how do you think about innovation and the companies that you invest in within that context?
I've had the opportunity to work with a lot of the Fortune 500s here in the Twin Cities around and on some of their innovation boards. And I think it's super cyclical, right? Like the how big enterprises think about innovation. It's sexy, then it's not sexy, and it's sexy. And it's actually one of the reasons that they tend to not be very good at it, because at the stage that we invest in early stage innovation, it takes 7, 8, 9, 10 years. And the people that are making the decisions today are probably not going to be managing those same P&Ls 10 years from now. And so it's really difficult to maintain consistency in it. The cool thing that's happening now is, and which might be different, and maybe I'm just wrong in this, but I think there's more opportunities to invest, to have a holistic approach where we're going to do internal innovation and building the practice around that. We're going to also partner with external organizations like a Techstars, which wasn't around before 2007. And there really wasn't, accelerators or incubators to the extent there are today, where you can actually partner with those organizations. And then, so there's a more opportunity to kind of take a holistic approach to innovation versus having to build it all yourself as an enterprise. And that might actually improve the longevity of it. I'm sure Mary has some thoughts on this too, since she built Google for entrepreneurs.
I think you covered it. I mean, I do, but I know we have a lot of great questions. I definitely think that's exactly our goal, is to harness that divide between the titans of industry and the emerging tech. And a lot of the platform work that Steph's doing is directly related to achieving that. So it's an exciting time. The one thing I'll share is we've been having, C-level, senior level conversations with a lot of these companies, and the appetite is through the roof right now for engaging with startups. And so it's very, very promising time.
And from our portfolio company perspective, it's like when we get one in that's in square in the space of a Cargill, we call the people we know at Cargill, right? And we talk to them and use it as one data point for us to evaluate whether or not we should put an investment play there. Now, what somebody from a big enterprise tells us, we're going to take it with a grain of salt also, right? So it's not always the yes or no, but it's a great resource for us to have when we're evaluating our investments.
So I think we have time for 2 more questions. So I'm going to pick, I think this is a great one for the 2 of you, and then we'll kind of get to the larger, where do we see the ecosystem going? But if someone is evaluating a startup to join as an employee, what criteria should you prioritize? Is it as simple as people, culture, amount of funding, or how do you think about that? I think it's a really interesting question, is because as a lot of these companies are growing in the Twin Cities, they are going to look for talent.
I'll dive in on this one, and Mary, you can maybe do the second question that she brought up. It's interesting, and we've had a lot of people leave big enterprises to go to startups that are in our portfolio, and I honestly, most of the time it fails. Like most of the time that it hasn't worked out because the culture, the startup culture, is so very different from enterprise culture. I think by far the most important thing is like the culture of the team you're joining. It is people. It's all about a people game. When if you're joining a 10-person startup, what I like to say is like, you are going to change the culture of that company by 10% if you are the 10th employee. That is massive culture change that you're undergoing, and that company is going to undergo by bringing you on. Whereas if you're employee number 10,000, it's very different, and it's a very different perspective. And so really spending time with the people that run that company is by far the most important thing. As far as like amount of funding that they've raised, like at the end of the day, that's more of like a personal decision, like what's your risk tolerance. So like certainly the more capital a company has on their balance sheet, the less risky they are. But you're also going to get less equity in that company, right? The further along a company is, like your personal equity stake and upside in that company is going to be significantly less the further along they get. So that's more of a personal risk tolerance question for you. And again, like I would actually evaluate joining a startup if you're like worried about what's the value of my equity in that company. I would go through just like you were investing in it, because you're investing with your most valuable resource, which is your time. And so go through that whole process. Like, is this a good investment of my time to join a company? But it's all about people for sure.
All right, so I'm going to bundle 2 kind of questions together. So one, where do you see, with the growth of the ecosystem over the last 5 years, where do you see it going 5 years from now? And specifically, kind of the venture funding trend moving forward?
I'm over the moon about the early progress that we're making, and I think that change and progress can be generational change, meaning startup life cycle, not our generation, which is really exciting, right? And even Brett alluded to earlier, so much of the activity we showed in the opening slide wasn't here 5 years ago. Currently, there are at least 7 firms that I know of at the moment actively raising their next fund in town right now. There's just this flurry of activity and excitement. So I think on the growth of capital side, another trend that we're seeing in addition to funds, new funds starting here, are national funds, coastal funds, putting a presence on the ground here and really making this their home base in the middle of the country, which is an awesome trend that we hope to see more of. And so I do think access to capital is going to become a little bit easier. I shared some numbers in the chat about we almost tipped $2 billion in startups, venture funding raised by Minnesota companies last year. A couple outliers, but those outliers are really important, right? Because the Series E companies are going to be the who's on deck to IPO. And so we need that flywheel here in Minnesota. So I think we're really well poised. The other phenomenon that's happening right now that COVID accelerated is coastal funds are willing to make remote investment decisions and are looking outside the coast. Just prior to this call, I was on the phone with one of the very large coastal funds that were trading deal flow because they're doing a lot in similar spaces. And we were joking about valuations. They're still playing the game of the story he shared with me, that there's 2 founders that are talking to him from a very, very large successful company about a $40 million valuation at an idea on paper. And so their desire to look at innovation between the coasts earlier that they're not seeing at earlier valuations is really through the roof. So I'm excited. I think the trend will continue. I think Minnesota is well positioned, but we need to do our part to, tell the narrative nationally, raise the visibility of what's happening here, what the opportunities are, and then do our part to invest and support and facilitate awesome companies to grow.
Anything you'd add, Brett?
No, that was great.
Okay, well, I'm going to close it there to give everyone a moment in between their next meeting at 1 o'clock, but I want to give a huge thanks to Brett and Mary and Steph from Bread and Butter Ventures. Thank you all for joining our first Lunch and Learn version of the CEO series. Please sign up for our next one, which is with Andy Cantwell from Carlson Private Capital. There'll be more events coming, so make sure you get the Harvard Club of Minnesota newsletters. And please take them up on their offer. Go to their website, sign up for office hours to connect and get more involved in our ecosystem. And we look forward to seeing you at our next event. Thank you so much again, Mary and Brett. Thanks, Steph.
Thanks for
Thank you,
having
Jim,
us.
as always.